Hi, good evening. Thank you for joining us on this webinar this Monday night. I hope that you and your family are very well, and I really want to say thank you to each one of you for taking the time and the effort to join us this evening. We are here live at MoneyOwl's office at Keong Saik Road. And my name is Chuin Ting Weber, and I'm the CEO and Chief Investment Officer of MoneyOwl. MoneyOwl is an NTUC social enterprise, and we want to help people from all walks of life to make wise financial decisions, including investing decisions that support their goals in life with as little stress as possible. And today with me is also Dr. Dai Wei from Dimensional Fund Advisors. She's the Senior Researcher and VP at the firm.
Thank you. Glad to be here.
Yeah, thank you for joining. Yeah, so Dai Wei will talk about Dimensional's approach, and as those of you who are MoneyOwl clients know, Dimensional funds form the building blocks of MoneyOwl's investment portfolios. So this is our agenda for today. I will start by sharing with you 3 ways of managing risks in this turbulent environment. Thereafter, Dai Wei will talk about how Dimensional as a fund manager navigates market volatility, and in between we'll have some exchanges so as to keep it lively. Now that should bring us right up to just before 8 p.m. And we will participate then in the Clap for SG, where we will honor and encourage our frontline healthcare workers, delivery people, people who work at immigration, everyone who is actually really helping Singapore to get through this. And we'll take a short break at that time so that we can all participate in Clap for SG United. And thereafter, we'll have about probably 20 minutes of Q&A. So please do now post your comments or your questions on our Facebook wall in the comment section, and we'll pick them up and we'll answer them in groups. All right, so let's get right to it. So I started by introducing MoneyOwl's mission has been to help people make wise financial decisions to support their life goals with as little stress as possible. But the last month or so in the stock market, I think has been anything but unstressful given the turbulence. You know, what do you think of this volatility?
Yeah, absolutely. You have seen stocks going down 5-10% on the way down in one day, and going up 5-10% on the way up. So
that's
definitely
right.
Very volatile.
So given these gyrations, I think it's very natural for investors or people looking to invest to think about how to manage the risks or what they perceive as a very risky situation. So I'd like to suggest that there are generally 3 ways of managing risk. The most common way that investors manage risk is investment management. Both individual investors and professional fund managers like to do this. But let's take a look at how the professionals do it. In the times of stress especially, you'll see that fund managers would like to change the portions that they put into different types of investments or different asset classes. When there's stress in the market, it is likely that you'll take some out of equities and buy more bonds, so thereby reducing the amount of equities in your portfolio or increasing the amount of bonds, because bonds are regarded as safer assets. Or if you're really, really bearish, many managers might actually move a big portion into cash. So this is sometimes known as tactical or dynamic asset allocation. The other thing that fund managers do is to then try to pick countries or sectors or industries that they would think will go down less or go up more. Now, going down less is as important as going up, because this in the active fund management space, one is often measured against one's peers in the market. The other thing that fund managers do pick are actual stocks. Which stocks you think will do better during this time, and which stocks are less bad during this time. And of course, there's always this push to get the timing right in terms of the tops and bottoms. Yeah. So Wei, what do you think of this timing issue?
That's very difficult to do, as you said. You have to get both directions.
That's right.
Right. You have to get in right and get out right, and you have also to think about the costs associated with those type of allocation changes.
That's right. And we'll talk more about Dimensional's approach to these things. So what's wrong with this way of active investment management? Well, simply put, the track record for it isn't very good. So if you take a look at this chart, which is a simple chart of the performance of the S&P 500 managers, or rather performance of active fund managers compared to the S&P 500 index, you see that actually in across all time frames of 1, 3, 5, 10, 15 years, the majority of fund managers do not outperform. Or put it another way, you see in the dark turquoise bars, actually it is always less than 50% who outperform. So what this means is that if in that 1 year the market was down, or if in that 5-year period the market is down, most active fund managers would actually have lost you more money than if you had just stayed invested. Or if in that time period the stock markets were up, this means that active fund management has actually detracted from actual fund returns. So this being the report card, but Wei, is it possible to say then, let's just pick those fund managers who are so good, the 35% in 1 year, the 21%, 17%, or the 8% in 15 years?
I think that's definitely the wish, but one thing is that when you look at so many funds, thousands of them, and some of them may have really good performance just simply by chance. So it's really hard to disentangle this luck versus skill. And also, really, when you look into the data, if you just look at funds that have performed really well in the past, you may not be able to get to good ones going forward.
That's right. So this road of luck, I think you can see in the fact that it's not the same people who outperform every year. So if you look at this slide, so we say welcome to the class of 2014, the top 25%, we have 571 fund managers who were out in the top quartile of performance, and let's say those outperformed the market. But over the years, the number of the 521 remaining dwindled drastically, and by the time you're in 4 or 5 years, you're actually down to just one. So this means that if you are counting on selecting the right fund manager, your chance in getting it right is actually only about less than 0.2%. So the odds are really quite against you. So what these two charts that I've shown you show us is that most active managers, or most managers doing active fund management, do not actually manage to outperform the market. So if you're trying to manage the risk of a down market using active fund management, you might actually this might actually be counterproductive. And so you have to be aware that you're actually adding risk, rather counterintuitively, by having too much activity. So, but the good news is that actually one does not have to stress out trying to manage this risk, because although the market goes through crises, the market goes through fluctuations, stock markets rise and fall, but they do have a certain tendency, or rather they always do recover, and they have a long-term trajectory. Where can you describe what that long-term trajectory is?
Going this direction, or maybe this direction. Well, positive expected return, I should say. As prices change, there's always a positive expected return that should be embedded in today's market price.
Yeah. So if we put it in layman terms, a positive expected return over the long term means that basically stock markets do go up over the long term. And perhaps I could give you first the logic, and then we can talk about the empirical evidence. Now, why do stock markets go up in the long term? Because stock prices, being the prices of the equities, the value of equities in companies, are ultimately driven by earnings in aggregate. And earnings are driven by demand, and global demand in aggregate are driven by factors such as global population growth and increase in the standards of living. So in other words, it's actually this human industry and this quest for a better life in the human condition that actually always goes up, which actually gives us a lot of confidence even during this time of the COVID-19 crisis. And because that goes up, stock prices over the long run goes up. So that's the economic logic and the fundamentals that we should remember. Now, what about the empirical evidence? So now let me show you this chart, which is a beautiful illustration of how markets have performed over the last 90 years. This is a chart consisting of many different boxes and numbers in them, and this represents actually the annualized or average returns of the S&P 500 index over the last 90 years. And let's zoom in, and here's how you read it. Each box represents the annualized or average per year return from the year at the beginning, or the top of the column, to the year at the beginning of the row. So if we started investing in 1928, you'll see that in the first year you have made a whopping 43.6% return. If you continued into the second year, your average or annualized return will drop to 14.7%. This is because of the onset of the Great Depression. But it's still okay, because cumulatively you're up about 31%. However, in this case, if you had stayed on in the market, you would have lost all your gains, and by the 4th year, you have gone into a cumulative loss position of more than 50%, or negative 13.5 analyzed over the 4 years. Let's take a look at what happened during the 2008 global financial crisis. In 2008, in that 1 year, you had suffered a loss of negative 37%. But in 2009, which is sort of opposite to the Great Depression, you had a very strong recovery. So by 2009, your 2-year average return actually narrowed, or your loss actually narrowed to around negative 20%, or negative 10.7 compounded twice. By the 3rd year, it's about negative 8.5%, or negative 2.9, 3 times over. But by the time we reach 5 years, you're actually in positive territory already. So let's take a look again at this chart in this zoomed out form, and let's take a look and see what we observe. We have color coded this chart so that all the greens represent when we have years when you have positive analyzed returns, when you are making money, and the reds and pinks for when you are losing money, when you have negative returns.
I see a lot of greens.
That's right.
Chart.
Yeah, so that's the first thing that you notice about this chart, which is that there's many more greens and reds. So this means that most of the time, investors are making money. Now this gives us great encouragement, because it means that when we're investing, we are okay most of the time. So Wei, what about the negative returns? Maybe tell us your observations of the reds in this chart.
Yeah, I see some patches of red returns, but they're all kind of closer to the off diagonal.
Yeah, so they're close to the edge. So remember, we count from the year at the beginning of each row, which starts on the edge or on the diagonal. So it means that it is the short-term returns that are very negative. The reds are all there. And if you look at the clusters, the vertical clusters of reds and pinks, representing multiple years of having a negative return, or multiple years when you're actually not making money, these happen once in a while. The Great Depression in the 1920s, the dot-com bubble burst in 2000, and the global financial crisis of 2008 and 9. Now, if you zoom in now and count from the top of one of these, the largest patch, and you count the number of boxes all the way down until you see no more red or pink box, we find out something. That as long as you have 15 boxes, or basically 15 years in the market, you cross over into a zone that is all green, which means that this is your safety zone where you are no longer losing money. So as long as you have 15 years, and even if we had gone through the same kind of downturn as in the Great Depression, you're very likely that you would be fine, looking at this empirically. Now, if you exclude the Great Depression, then we're talking about probably closer to 10 years. Now, obviously, this is not, history never replicates itself perfectly. History rhymes. But I think this should give you some confidence. And I encourage you, and maybe you can take a screenshot of this right now and keep this with you, this green fuse chart. Yeah. So what this tells us is that it is not your timing or when you start, because as long as you can cross the line, you would be fine. Now, for a 100% equities portfolio, like we said, it takes maybe 10 to 15 years. Now, if you have less time and your risk appetite therefore is different, you are in a balanced portfolio, about 60% equities and 40% bonds. It takes about 8+ years or so to cross the line based on history. Right. So at this situation, I think we need to know that investment management actually lies in having the time to stay invested, and perhaps rather counterintuitively, it is doing the same thing over and over again rather than trying to do something extra and something too much activity. That is the discipline that is needed in these markets. And really, don't turn a temporary paper loss, which is what happens when you're in the pink zones, into a permanent temporary loss, into a temporary decline into a permanent loss. Yeah, this is the right way to do investment management. Yeah. So what about the oh, okay, I forgot this advertisement that my marketing people want us to do. So given that it is always the time in the market that matters, what we say is that the best time to have invested is actually 15 years ago, right? Or 20 years ago. But the second best time is always today. because when you start today, then you have the longest runway to your goals. So that is really why we have started to encourage people to start to invest. And for new investors, you have on your screen a promo code, and this is something you can find on our website as well. And for existing investors, we encourage you to do a top up at this time if you can, and to enjoy the promo rate. Okay, so let's move to the second way of managing risk in a turbulent environment. The second way is actually financial management or financial planning. Now, we all have a personal money equation that looks something like this. We all earn an income, out of which we would save into investment portfolios over the long run towards our goals. Out of our income, we also spend for both variable expenses and fixed expenses. Now, even during normal times, we need to take care of our income, because income is our most important financial asset that keeps generating the savings that are needed for our long-term goals. And of course, funding our expenses. We also need to budget, and so they can control our expenses, and we need to take care of these two. And we do have to have the appropriate insurance to ensure that our plans don't fail because of something like a medical crisis that can affect our income, that can cause us to lose income, or can actually give us catastrophic expenses. So on the left side, it is what actually you can control better. And if you can get this part right, this most important financial asset part right, you actually will use, based on this, you should become rich based on this. Right? And the short-term fluctuations in the market actually speak much more to the left side of the equation rather than to the right side. On the right side, which is your long-term part of the money equation, is about investing. You can't control that much what's happening in the short term, and you don't need to, as long as you do not have to liquidate your investment to fund your expenses. And if you can't control it, and it actually only helps you to stay rich, it doesn't really make you rich, you know, if you don't keep investing regularly. Yeah. So what do we do now then in terms of financial management in such a stressed time as this? Here are some suggestions for you. Well, firstly, please keep your job. So keep your job as far as it depends on you, based on this being your most important financial asset. And how do you do that? You do that by becoming so good at your job, in terms of your competence and your attitude. Let your CEO want to retrench himself or herself before retrenching you.
That's what I'm trying to do every single day.
Good for you. So that is, it's really how you up your value, right? It is a human capital value.
Human capital,
right?
Absolutely.
Yeah. So don't, what I'm saying is that don't depend on trying to punt on the markets to make up for this, because it doesn't work. You really have to look after your most important financial asset, which is actually yourself. Now, the second thing is, of course, that please keep an emergency fund of about 6 to 12 months. I think some of you might have gotten some bonuses around the beginning of the year. This is a time to make sure, if you do not already have an emergency fund, 6 to 12. If you have an emergency fund, you will not really be afraid of what happens in the markets, because you never have to liquidate your investments when the prices are down in order to fund your daily living. Don't increase your debt at this time, because the times are really uncertain, and do control your expenses. Maybe tighten up a little bit more. In terms of insurance, please stay insured. If you're not insured, especially for things like medical expenses or that, please do speak to us. I mean, the last thing you want is to have some personal tragedy just really totally wipe out whatever expenses and savings you have, and it does not have to be expensive. And for those who are retirees or near retirees, concentrate on cash flow management. When you are withdrawing out of an investment portfolio in a down market, you have to be very careful not to overspend or to withdraw too much. So there are several ways of doing this, either through a withdrawal bucketing system, or at least have a kind of a withdrawal rule, right, to guard against what we call sequence of returns risk. Right. And now let's move to the third way of managing risk in this time, and we call it self-management. Now this is actually very, very important, because often what the head knows does not connect to the heart. Now the head knows that we should stay invested. The head knows that this is something in the short term that will blow over, although we don't know when. But when you look at the CNBC and you see those big swings, 10% one way or another, it is quite natural that you might be scared, and especially if everybody else is asking you to exit. Let's go, let's take risk off the table first and come back later, which has its problems because people actually do not know when to come back when the market recovery is very fast. So what do we do to help ourselves? Well, the first thing is, please remind yourself of the evidence about the markets, both the logic and the empirical evidence. So take out that screenshot that I asked you to take and look at the green fields and feel happy about that. The second is get a coach. You have an advisor who is competent and who is conflict-free, and this advisor will be able to remind you of all these things about the markets. And we talk about how fund management alpha can be quite elusive, in terms of trying to outperform the markets. But when it comes to advisor alpha, I think through the value add, there is actually a real benefit to clients here. According to this study that Vanguard had done, it could be up to about 3%, which is a big deal in investment returns. Adding about 3% to your annual portfolio return. And finally, we ask you to take a step to give yourself a psychological edge. This step of topping up with some dry powder, which is cash that you set aside over and above your emergency fund and over above your regular saving. Now, those of you who are MoneyOwl clients would have seen my notes or would have received a call from your MoneyOwl client advisor asking you to consider topping up when markets had fallen. Now, why do we do this? Now, we are certainly not trying to time the bottom or call the bottom in any way. We would like you to give a booster to your plan because this is, you're buying at lower prices, and then this can add to your return for that portion that you invested. But actually, the real reason that we ask you to do this is to give yourself that psychological boost, because once you have done a top up, you are no longer afraid or fearful of market downturns. In fact, you can be quite excited about the opportunity to build your wealth further. So, in summary, 3 ways of managing risk in these turbulent markets. Firstly, as far as investment management is concerned, simply stay invested and keep investing regularly. Secondly, make good financial planning decisions. And thirdly, get reminded of what evidence and logic about the markets. Get yourself advised or coached and capitalize on the opportunities using your dry powder in a time like this. So I've come to the end of my segment, and I will turn to Wei to talk more about Dimensional's approach in navigating market volatility.
Absolutely, thank you.
Yeah. So Wei, thank you again for being here on this evening to be with MoneyOwl's friends and clients. So perhaps you could tell us a little bit more about what you do and more about your firm.
Yeah, absolutely. I'll start with a quick overview of what Dimensional does. Dimensional is a global asset management firm that was founded almost 40 years ago in 1981. And we have clients around the world, and including a lot of the independent financial advisors like MoneyOwl, who share our vision and who share our philosophy of doing the right thing for investors. Globally, we have 13 offices. We are headquartered in Austin, Texas, in the U.S., and we came to Singapore in 2012 as a strategic move to come to Asia and better serve clients in Singapore, also in the Asia ex-Japan region. I am one of those 1,400 employees at Dimensional and part of the research team. Yeah. So as a researcher, my daily job involves, I would say, 2 buckets. One is to do empirical research on any investment-related topics that our clients are interested in, and getting my hands dirty with data. So part of me is really, really nerdy. But the other part is to talk to clients about our research findings and then to explain to people why Dimensional. And just like today, it's always the highlight of the day is to be able to talk to clients.
That's great. So, but what attracted you to join Dimensional? I mean, you can do research everywhere, right?
Yeah, I think one thing that really attracted me to Dimensional is the philosophy that we believe markets work. It's just a philosophy that makes sense to me. And also the fact that everything we do is built on rigorous research and financial science. And actually, as you can see on this slide, since the very beginning of the firm, we have maintained a very close tie to academic world. So we work with some of the brightest minds in academia. So on the slide, you can see some of the big names. They are probably the leading financial economists that we work very closely with.
So I see many Nobel Prize winners here on this dimensional slide.
Yes, I think
impressive.
It's a privilege that we can work with them very closely. You see Eugene Fama, the father of modern finance, Bob Merton. So they have contributed a lot to the financial world. But I guess one thing that I didn't know until I joined Dimensional is how closely they are involved with Dimensional. So they not only serve on the boards, on important committees, but they also work very closely with us on research projects. I remember some of the first meetings with them I was quite nervous before going in, but in the end, they share a lot of insightful comments, and then they always push us and set the bar really high for our research and for everything we do. I think now probably a good time for me to share a quick video of where our founder David Booth and also some of these academics we work with talk about Dimensional. Because if you think about the research they do, a lot of people use their research. However, they decide to be associated with us, Dimensional. So I think it's good to hear from them why that's the case.
How is Dimensional different from other money management firms? I think the critical difference is the way we look at markets. We trust the markets. And over the long haul, that approach has served us well.
Dimensional is a firm that's dedicated to implementing the great ideas in finance. That's what we're about. The idea was a small company fund, and we went out and tested the idea, and we were able to get a few clients. Obviously, we had no track record. Our first office was my apartment in Brooklyn Heights. It was a 2-bedroom apartment. My brother had been living with me, and he moved out and used that second bedroom as the trading room. It was run on the thinnest of margins, and we didn't exactly have success written all over it. When you start a business, one of the first things you worry about is, and people say, oh man, everybody knows that. So I was particularly concerned about, was there research out there that we didn't know about, could be used against us? So my first phone call was to Gene Fama. I had worked for Gene as a research assistant and teaching assistant. And I called him up and said, look, here's what we want to do. And we invited him to be a founding shareholder of the firm and on the board of directors. We're blessed with working closely with Fama and French, who were largely the people that developed the data. One of the first things we discovered in running a mutual fund was that a mutual fund has to have its own separate board of directors. And so we thought, who better to monitor what we're doing than other leading academics? So we went over to the business school in Chicago, and first person we talked to was Merton Miller, who eventually would get the Nobel Prize for his work in cost of capital. And we asked Merton to be on the board, and he agreed. Next door was Myron Scholes, and we went into his office and invited him to be an independent director of the mutual fund as well, and he also agreed.
I think of it more as an investment philosophy that draws on the academic community.
We think that distinguishes us from the other managers. In this process, we have, the best minds, the people that have developed the research that leads to these conclusions about dimensions. So we're very comfortable with our process and very pleased with the results that have been achieved with it.
I mean, basically, and I don't know anybody else that would ever have this attitude, they feel that they should just let us do our research. And if something comes out of that they can use, then they will do it. But basically, they think we're working and it can be profitable to them, even though it's primarily academic work.
Dimensional, unlike any of the big banks or others that you would think of, or even other fund complexes, was founded on finance science. So the culture from the beginning matched my culture.
I consider myself to be an incredibly lucky guy. Have had the exposure to these great people with great ideas, be able to implement them.
There are many other companies that have used our research without us getting involved. Dimensional, they are different.
It's been fabulous working closely with such talented people. And I think what's great as well is that the biggest beneficiaries of all of this, hopefully, are the clients. At the end of it all, it's about the implementation of the great ideas. And these ideas are much bigger than the firm.
So Wei, based on what we've heard from you and also what we've seen in the video, Dimensional really... So Wei, based on what we've heard from you and seen in the video, Dimensional really applies the rigor of academic discipline and also financial science in managing its portfolios and even developing the philosophy. So how then does this inform the way that Dimensional looks at the current volatility in the markets, which is even much more extreme than what was happening in the GFC?
Yeah, I think it's definitely the case that we have been through a very volatile time period. And I think in order to think about what to do in current situations, it's good to put current volatility into a historical perspective. So what we are pulling up here is a slide that shows the distribution of daily returns of the S&P 500 index. So you can see that the bulk of the distribution is probably anywhere between -2% to 2% in terms of daily returns. So as we said earlier, there were days with -5 or even 10 and +5 and 10. So they're definitely in the tail of the distribution. It's not something we haven't seen before. There are a handful of cases with those large swings in the market, but it's definitely on the more volatile end. While I think it's definitely quite stressful to watch markets go up and down like this, we shouldn't lose sight of the fact that when things are uncertain and when there's a lot of stories unfolding in the marketplace, like how the coronavirus is going to play out, that's what we should expect from a well-functioning market. So what we show on this slide, if we can go to the next slide, is that if you think about what the market is doing, the market is a powerful information processing machine. So how much trading is going on a daily basis? On average, global equity is trading $460 billion. That's a tremendous amount of information that's being exchanged between buyers and sellers, and information get into today's price. And when you look at current, in the more recent time period, you see even higher trading volume than what you typically see. So indicating that information is flowing.
So markets are functioning
as you would expect.
Okay.
Yeah.
That's
and
good.
I think as you would expect that as things unfold, information gets into market prices that will lead to more volatility. But in the end, it should be the expected return of the stocks that's embedded in today's market price.
So how do we see short-term volatility versus longer-term volatility?
Yeah, I think that's really the key when you think about how to deal with this type of uncertainty. And the best advice we can give is to really look beyond the headlines and look beyond short-term variations. So here we have an analysis where in the blue bars we show the annual returns of S&P 500. You see some positive years, some negative years. But what's more interesting is what's shown in those in the whiskers. The whiskers are showing the largest intra-year gain and intra-year loss. That's, you can see, much wider than the blue bars. Right?
So the swings in the short terms are much larger and much more violent in that sense than the swings in the short term and then the long term. So if you just gone to sleep, and you woke up at the end of the longer term period, you would not have experienced that. Those gyrations and volatility.
Yeah, I think that's well put. And sometimes we say that a market downturn doesn't mean that you will end up with a down year, right? For example, if you look at 2009 as an example, the largest intra-year loss was around 28%, but that year ended up being delivering 27% positive return.
That's right.
So what's happening in this on the daily basis is not so indicative of what's going to happen over the long term.
So how should investors invest then during these volatile times?
Yeah, I think one thing you can do is really look at the long term. So here, if we zoom out, look at what the global equity market has delivered, what do you see? It's a line.
The line that goes up.
Going up, that's the general direction, right? And I think also more interesting is we're overlaying this chart with some of the headlines at the time. I think a lot of times markets have a quite short memory and thinking, okay, coronavirus is the worst thing that would happen. But if you look at what has happened previously, there are all kinds of crises that the market has gone through. If you think about Brexit or some trade war or
wars.
Financial, a lot of these different. And that leads to this line being a little bit up and down. But over the long term, you can see that global capital market has rewarded investors that has discipline.
So another screenshot for our psychological toolbox.
Yeah, I think the next one might be a good one too, where we actually look at what happens after market downturns.
That's right.
So here we're looking at, again, market going down by 10% or more. And then we say, okay, what's the average return after the 1 year, 3 year, and 5 year period? You can see that on average, market has given you around, let's call it 10 percentage point after those downturn periods. Again, showing how resilient the capital markets are. And again, showing that if you are not there to capture those returns, it's hard for you to catch up.
And would the rebound actually even maybe be sharper when you're looking at very quick downturns?
Yeah, we do see that rebounds can happen very quickly. So markets can turn around, fast and furious. That sometimes we say. And maybe another one we can look at is not just look at market downturns, but some of the specific crises that we have gone through. I think this one is a good one to again put things into context. Here we're looking at a few different crises because a lot of times people say, "Oh, this is a different crisis." Of course, the cause will be different each time. But if you look at what the markets have done over the short term, yes, you may experience some loss. But over the long term, you're getting that positive return delivered by the market. So again, I think lots of analysis supporting what we have just said, that discipline is a key when it comes to capturing what markets have to offer.
But what if people try to move in and out then? Kind of take risk off, come back later.
We have done a lot of those analysis looking at research into the timing strategies, and what ends up happening is you actually are more likely to be worse off because the market should give you positive expected return. So that means whenever you switch out of the market, the odds are stacked against you. So a lot of times you may actually miss out on that positive return.
You mean like if you because you're trying to take the risk off the table and you try to come back in, but you may not be able to come back in quickly enough, and especially when actually most of the time markets being leading indicators actually bottom before the fundamentals actually turn around.
Because a lot of times, yes, a successful timing strategy requires you that benefit of hindsight, right? It's a lot easier to say, yes, that was the bottom, but at the time, it's very difficult to tell. So I think this analysis is a very telling one where it tries to quantify what you can potentially miss out on if you don't stay disciplined. So here we're looking at this 29-year period starting in 1990. If you stay invested in the S&P 500, what do you get? $1,000 will grow to more than $13,000. So the market has not been a bad place for investors. But what if you just miss the one best day, the single best day? Then that end wealth is decreased by about 10%.
Yeah.
What if you miss 25 best days out of that 29-year period? What do you get? You get just a quarter of what you would have got.
So in other words, if you thought that you were being prudent and managing your risk by staying out, you actually end up risking your goals, because if you're stay invested, you'll be at the 13,000.
Absolutely, because we think about investing, there's always some uncertainty embedded in investing, right? If the market is only going up, you would wonder why it should be positive in the first place. But then by doing these type of timing strategies, you're actually adding additional unnecessary risk that you could have put away.
Yeah. So it seems that if we're happy with a 8% or so return over a 10 or 20-year time frame, which we really should just remain invested. But do we have to stay invested in the same composition, of our portfolio? Earlier we had said that managers do try to look at which countries or sectors that perform better. And how does that work out?
I think one thing is that I definitely hear that claim, because when the market volatility is high, it's also the time when the cross-sectional dispersion of returns that can be quite wide. So some stocks may do really well, some stocks may do really poorly. So people say, well, why don't we try to identify those winners, right? Be it winning stock or winning sector or winning country.
Countries, yeah.
Exactly. Can we do that? I think the next slide will show you some of the challenges associated with that. So what we are showing here is what we call quilt chart. Every year by column, we're ranking the developed country returns from the top to bottom. And the countries are color-coded. So what do you see from this chart?
It looks like a tapestry to me.
Yeah, you probably cannot see anything, right? That's the point. There's a lot of randomness in these country level returns. And then we also have done more rigorous research and see, okay, can we use certain variables to try to time who will be the winning country? We always end up concluding that staying disciplined and being exposed to all the countries out there will give you the best chance of outperforming.
Yeah. So I guess to put it in current context, I do have people who say to me, oh, looks like China is coming out first and China probably will be the winner versus the US, so maybe we should put now all our eggs in the China basket and all that. But I guess if you take a step back, it would probably end up with one of these lost in this tapestry of randomness.
Yeah, and I think a lot of times you may have a correct prediction, right? You may know that, okay, maybe the viral outbreak may be worse or better in certain time periods, but those information again is already embedded in today's price. So that's not going to help you make better investment decisions.
So should we then maybe own the whole world?
I think that's definitely a natural starting point. A globally diversified portfolio that has hundreds, thousands of stocks, and I think today is probably the best period for a global investor because you can actually access that many stocks in such a cost-effective way. And speaking of that, I think I would also emphasize that it's not just about being globally diversified. Within each country, you also want to be as diversified as possible. Again, I will show you an analysis about try to quantify that if you are not fully diversified, what's the potential of missing out on some of the winning stocks. So that's showing the next slide. It's a similar one as to that the timing strategy. Basically, we're showing, okay, this is the global return since 1994. It gives you more than 7%. That's
right,
a decent level of return. But what if you miss out on the top 10% of the performance every year, right? Let's say you do stock picking or you just have a very concentrated portfolio, and your return is down to only 2.9%. So that's a stark difference. And what if you miss the top 25% of the best performing stocks every year? Your return is negative 5%.
That's right.
So it shows that every year, yes, the return is going to be delivered by a subset of stocks, and the subset will change every single year. Since there's no way to predict which stocks will end up delivering the return or delivering the premiums,
and which one
you want to put you don't want to put all eggs in one basket, basically.
That's right.
You want to be as broadly diversified as possible.
Yeah. So in that sense, I'm very glad that for MoneyOwl using dimensional funds, each of our portfolios has about 8,000 plus securities. Actually even much more than the index in that sense. And as they say in finance, actually diversification is the only free lunch, because that's when you can get rid of all your unsystematic risks.
Absolutely. That's why you want to be as diversified as possible. Your best friend for you.
But if you're just sticking to that global portfolio, for dimensional, you won't describe yourself really as a passive fund manager. I mean, we describe dimensional as being evidence-based investing, or at least using your core funds, enhanced index investing. But so you believe that it's better to do better than an index. So how is your approach then different from the traditional active managers who actually do pick countries and sectors and stocks?
Yeah, what we often say is that we are trying to outperform the market without outguessing market prices.
Outperform without outguessing. So how do you do that?
Yeah, and I think that really goes back to the financial science that I talked about earlier, that there are differences in expected returns across securities. And that should be natural to think, right? Because if you think about you were to lend money to me, to your colleagues and your relatives, you may end up charging different interest rates.
That's right, yeah.
Right? And that's a natural starting point. And then that's also the case when you think about the securities out there. They should have differences in expected returns. That means you don't have to settle for market-like return. The market portfolio is a good starting point, but you can emphasize stocks with higher expected returns and de-emphasizing stocks with lower expected returns. That way you can get a higher expected return. So let me talk a little bit about what actually drives the expected return. We have identified a few different premiums, or what we call the dimensions of expected returns. The first one is just market versus T-bill. That's why investing in equities gets you the market return. That's why we always want to stay invested. We already talked about that. Now let me talk about the within equities. What are the differences in expected returns? These are the company size, relative price, and profitability. And there is a good intuition behind why these premiums should exist in the first place. It goes back to the valuation theory. Basically says that the expected return of any security is determined by the price you pay and what you expect to receive.
That's right, yeah.
And how do you get a higher expected return? Paying less, getting more, getting higher expectation, or a combination of the two. So that's why when you look at company size and also the relative price, these are price metrics. So smaller cap companies have higher expected returns, value stocks have higher expected returns. And then profitability is the other side of the coin. That gives you higher expected cash flow. And all else equal, higher profitability means higher expected return. So that's what our portfolios have been built around. And if I give you some empirical evidence, we have decades of evidence that support the existence of the premiums. I know the slide is a little bit busy, so let me just walk you through. We're showing the existence of these premiums across different regions.
So they are pervasive across markets and across time?
Absolutely. So we're looking at long periods of time. And for example, if you look at the first row, the two gray bars shows the performance of a small cap index versus that of a large cap index. And the difference is shown in that blue bar. That's the size premium. So you can see size premium in the US, in developed ex-US, in emerging markets.
The premium being the value at or above the market
the return difference between the two sides.
Oh, the two sides, okay.
Small cap versus large cap,
caps,
for example.
okay.
And then similarly, if you look across the rows, you see positive value premium and you see profitability premium. So there's a compelling evidence that's consistent with the prediction of the theory.
Okay, but let me challenge you there, because these are averages, right? So if you have 6 pieces of bread and I have 0, the average is 3. It doesn't really mean very much. So
I will always give you 3.
Thank you very much. Yes. But in these are average returns. So do I get them every year?
No, absolutely not. And I think this will lead me to my favorite slide. That is really the one that helped to set expectation. Because today we've talked a lot about the markets going up and down, right? That's shown in the first row. We're showing the annual observations of the market premium. So sometimes market outperform T-bill, sometimes market underperform T-bill. But just like how the market can be volatile, these premiums can be volatile too. The averages I showed you earlier, there's actually very few years when the average, when the realization is within a narrow band of that average. So there's a lot of volatility associated with these premiums. I think one thing is that we cannot really predict when those premiums will be positive or negative, but there are a lot of things we can do to increase our reliability of outcomes. I'll talk a little bit, a few of that. The first one I'll talk about is to have a long-term perspective. Just like how you invest in the market, right? If you just invest stocks in 1 second, you're probably 50-50, right? Yeah. But 1 year you get more blue bars. And if you look at longer term, and which is shown in the next slide, we're looking at the rolling 10-year periods of these premiums. What do you see?
Well, let's see, many more blues.
Yeah, you see many more blues, and that's because over the longer term, you get a higher probability of realizing those positive premiums. So that's point number one. Being a long-term investor and stay disciplined in these premiums will help your reliability of outperformance.
But I do see on the third row, towards the right, a little patch of red rolling 10-year returns, meaning on the value front, right? So is there something broken there about the value premium?
That's definitely right, that there are periods, actually if you look at even 20-year, 30-year periods, there will still be a probability of negative premium. And you have seen that on this slide as well. The equity market has gone through 10-year periods when the premium is negative. So it's not outside of the realm of possibility for us, but you need to account for it. How can you do it knowing that there is still non-zero probability of performance? That leads me to the second point, which is to integrate multiple premiums.
Okay.
Because if you look across these columns, what do you see? There are
Well,
very few years.
If you add if I could add them, add the colors, I expect to be more blue than red.
Exactly,
in
and then
general.
there are very few years when all of these bars are red, right? And that's helpful because that means these premiums don't move in lockstep. So having a portfolio, let's say a core portfolio that holds thousands of stocks and simultaneously emphasize size, value, and profitability, that will mitigate the negative impact of one premium underperforming, for example, in this case, value performance.
So I guess it always helped me that to hear Dimensional describe this as like a bit of ice cube tray.
Yes.
Right. So maybe you tell the story.
Yeah, so the way that we think about how we manage or how we tilt, that's why we call these are the tilts,
yeah.
is that if you think about ice cube tray, that's your market. If you fill it with water just evenly, that's how you hold everything at market cap weight. But there are certain directions that points to higher expected returns. So you can tilt your ice cube tray, and so that the water goes out of some of the buckets with lower expected returns and into the buckets with higher expected returns. And you want to do it in a controlled and even way. So and then you want to do it with a cost-effective approach.
Right. So talking about the cost, I mean, it sounds like there's really a lot of brains that have gone into this, and it sounds like you have to do a lot of work for this tilting and in designing the strategies. But at the same time, Dimensional's fund fees at 0.4% per annum or less, actually, for those in our portfolio, they are low compared to the retail fund fees in Singapore, probably about a quarter of those fees or less. So how do you achieve that?
Yeah, I think definitely being cost efficient is a key consideration when we think about managing a systematic approach. We want to make sure that our investment approach is scalable and repeatable and cost efficient. Because at the end of the day, the more we save, the more that's ending up in our investors' pocket. And I think I can show this framework. It's a very straightforward one to show in the next slide, which is if you think about the premium that we talk about, that's in paper, right? What you end up getting is that premium net of the cost, right? So that's the net return that you get as an investor. How do we make sure that the cost doesn't overwhelm the premium we end up we pursue in the first place? We try to build broadly diversified portfolio with very low turnover. That means with low turnover, there may be low costs associated with the turnover. The other thing is when you think about each of the turnover and trading, we spread out all of our trading across 252.
So you don't have to do it
days.
at a certain time.
We don't have to do it at one time.
So you don't have a portfolio manager running after a trader and say, I want it now, I want to buy it now.
Exactly, because a lot of times if you talk to our trader, they will tell you the best thing you can give them in order to get the best execution done is to give them the ability to walk away.
That's right.
That's probably the best you get when you come to negotiating on a negotiation deal. But what ends up happening is we have the built-in flexibility in our investment process. That helps tremendously to get the cost low, in addition to the fact that we're also spreading across all the days. Here is an analogy that I quite like that shows why flexibility helps. It's just like how Chuin Ting said it now. Here we're using a car buying example. Right? If a manager tells you, we have to get this Apple stock at this today and this quantity, what do you end up having? You probably don't get a good price. Just like showing in this example. If you say, I want to have this particular model, this color, and today, you don't have any ability to negotiate. But what if you're flexible? That's like dimensional. We say, well, I want something with 4 wheels, and and I maybe want something that's not too big, and I'm flexible about the time of buying. You end up getting a much better price.
So in this regard, actually, also compared to a pure passive investing approach, you do not have the technicals of the reconstitution day, right? Which is when you really have to reconstitute on that particular day because there's a rules on the index. So that flexibility actually works in a sense both ways to your advantage vis-a-vis the traditional active managers and possibly also vis-a-vis pure index.
I think for both of those approaches, you don't have the same flexibility in terms of when to trade and what to trade.
So I'm glad that we, in that sense, MoneyOwl, we are able to access for our clients these best of breed solutions with you doing a lot of work, but at the same time keeping the cost low, and that's one of the key reasons why we choose dimensional funds, because keeping costs low so that you capture more of the return is one of the key tenets of our investing philosophy.
Yeah, if I can add maybe just one more, just how we run our business, I think it has to do with how we work with our independent financial advisors. You won't see us in advertisement. You won't see us in TV or MRT. We don't spend money on those things. We have relied on partnering with advisors like you guys who share our vision, and we have enjoyed organic growth. So that's something we're really proud of. But I think that's also partially why the cost of running the business is lower.
Yeah, I think we are all aligned towards really enriching the experience of investors so that they can really reap as much return and in the market return for their life goals. So do you have any last takeaways for our clients?
Yeah, absolutely. I was in the last slide, I was trying to maybe summarize what Chuin Ting said and also what I said, which is if you look at in terms of investor, what you can do, if you want to get where you want to be, you need a plan. And that plan should start with your own needs, your constraints, your objective, and your risk tolerance. And then you want to make sure that the funds underlying that as an allocation are broadly diversified, have low cost, low turnover, and also pursue value-added solutions for you, higher expected returns. And then in the end, I think that's also probably the most important thing when it comes to periods like this. You want to be able to stick to that plan. And I think in that regards, kudos to some people like Chuin Ting who have been doing a lot of risk coaching and hand-holding so that you can stick to the plan and enjoy the benefit of the good investment outcomes. I think with that, if we have we do have 3 minutes left to show you a video. I think it's a powerful one to show that if you can look beyond headlines, and you will get that ease of mind, and you will get a better investment experience.
The stock market on a rocket ride, blasting through a ceiling and closing at an all-time high.
Cheers of joy on the trading floor.
The internet revolution and the rise and fall of the internet stock bubble has become one of the most dramatic business stories of our time. In April of 2000, the bubble burst when the NASDAQ collapsed and dozens of dot-coms folded, losing billions.
If I'd have taken your advice at any point in the last 2 or 3 years, I'd have lost a fortune.
A huge percentage of jobs created has been because of the housing boom, whether it's construction, whether it's mortgage.
Bear Stearns is fine. Do not take your money out. This is risk. If there's one takeaway other than that,
today, with Wall Street shaken to its very foundation, dollars in market value today alone. The numbers even more dramatic when you're looking at the annual for 3-year period. There it is down.
So this comes to the end of our presentations, and we'll take a short break now so that we can participate, those of us who are here. There are not that many of us here today, but we would like to participate, and would like to encourage you also to go onto your balconies and your windows and clap for SG United, for all the people who are working frontline, in more ways than one, to encourage them so that we together can get through this COVID-19 situation, yes, together as a nation. And we'll come back and reconvene at 8:05 for Q&A. Please continue to put your questions into the Facebook walls comment section. Thank you.
All right, so we are back with the Q&A segment. And then my name is Sherry. I'm from the marketing team from MoneyOwl. And then I'll be moderating this Q&A. Don't worry, I'm actually with them. They're just opposite me. This is there because you have to do social distancing. So we're doing this setup right now. So the first question that I have for Wei Dai is, how is Dimensional managing investments in this volatility?
Okay. I think overall the goal for us is to deliver a robust portfolio in all market conditions. And in the current market condition, what you see is that the coronavirus outbreak has a significant impact on market volatility, but markets are designed to handle such uncertainty. So that means current market prices are reflecting any potential impact of the viral outbreak on individual companies or sectors or economies. So rather than trying to outguess market prices, our approach is to remain invested, remain consistently focused and broadly diversified, and focusing on the securities with higher expected returns, and and also with the desired characteristics of each strategy. So our approach has been consistent. Whenever there is higher volatility, we do increase the monitoring of market conditions that could affect our strategy or investment. So we closely monitor liquidity in the market, how markets are trading, what's the overall trading volume, and then we have a daily investment process that keep taking into account all of those changes and latest market information. And because of the built-in flexibility we talked about earlier, we are able to get still deliver a robust portfolio and maintain the desired exposure in a cost-effective way.
Yeah. I think from the advisor's point of view, if I may add, we are in touch very regularly with Dimension, especially during such times, to find out if there's been any issue in trading and liquidity. And actually, we're very glad that Dimensional maintains the same approach. Because the worst thing is that as an advisor, we tell you to stay invested and don't time the market, and then the actual fund manager is actually doing it. So actually that's one of the reasons why we're actually very happy to have Dimensional say that they're not doing anything differently than what their philosophy says.
Yeah, I guess to your point, we're also increasing our communication with clients so to make sure that you know what we're doing, and also and we are preparing a lot of performance reports and help you make informed decisions.
All right, and then the second question we'll take from the comment section, again for Wei Dai, is Dimensional considering building a fund where the underlying assets are SGD traded cash value insurance policies, similar to the GPP one in the UK?
I'm not an expert in this one. I may need help from Chuin Ting. Based on my knowledge, I'm not aware of the plan of this type of solutions. And generally, when we think about the solutions that we build, it's based on our understanding of the market and the financial science, and the technology available in the marketplace, as well as the client demand. So maybe Chuin Ting can help me a little bit on whether there is a lot of client demand, and then we can take from there.
No, I mean, we are not very familiar with this GBP. But if it's about trading and if it's about insurance-linked policies, I think for MoneyOwl we have the market in Singapore for insurance-linked policies is quite specific. I mean, as you understand what they are, and for MoneyOwl we do not advocate insurance-linked policies because we don't think they make very much sense. I mean, it's basically unit trust that is you are restricted to what the insurance has, and you should keep insurance really for protection, and we have the investments should be sorted out separately. Yeah. Not really because we are going buy term and invest the rest, but because term insurance is actually the best way and lowest cost way to get you covered. As for trading of actual insurance policies, be it the cash values and all that, I think that's probably not the kind of asset class. If that's what the question is about, I don't think that's the kind of asset class that we specialize in, or even Dimensional would specialize in, at least for global markets. I mean, specific markets, I think that will be different. And I cannot imagine that the liquidity for such in Singapore would be very deep for such assets.
Yeah, and I think if you think about broad diversification, cost-efficient execution, those are all the things that we care tremendously about when building a portfolio.
All right, let's go to the next question. It's more about the markets and investment planning. So this is asked by Nicholas. So he said, being born in 1990s, this recession is our generation's first recession and the stock market crash. Question is, with us all being very excited to partake in the first time to invest, what would you recommend for us being in the generation to approach investment?
You want to?
For me?
Yeah, sure.
Okay, sure. Okay, so in the 1990s, actually, you have participated. It's just that you were probably like 7 years old during the 1997 crisis, and then not in 2008. Yeah, so if you're born in the 1990s, I think probably you'll be starting to look at how do you build your financial future, right? So I think the first thing is that let's get your financial foundations right. And this is really about saving, right? It's about saving, and it's about getting your income minus expenses ratio correct. Right? And you know all I talked about on the financial planning side about being good at your job and growing your income. I think that's very important. So get some of these foundations right in the financial planning side. Now then the next thing you do is what I say about the emergency fund, because you need to get financially healthy before you can run the marathon, and have that emergency fund of about 6 months at least that we think you should have. Now, of course, at the same time, get your insurance right, because you can be young, but you can never know when a medical problem can hit, and there are some things that can really cause your plan to fail. I assume that you have all these things right. Now, this is actually a very good time for you to start saving regularly towards your end goal. And if you do have, you're in a good position to have a part of your assets, you have an added bonus. That besides starting young, you have the added bonus now that markets actually come down from the peak. Any time is a good time to start investing, but you are in a good space as far as where the markets are. So I would advise that you should start in a globally diversified portfolio, and you could start with a combination of a lump sum. But the most important part is to actually keep investing regularly, keep saving after you've gotten your financial foundations right.
Yeah, maybe I would just add one more thing, that if you think about your asset allocation, we've done some research on what we call life cycle finance. Basically, if you think about your whole wealth, a lot of your wealth is actually in the form of future salary. So that's what we call human capital.
Yeah.
So your financial capital is maybe a smaller chunk of that overall balance. So that means when you are still young, which you are, then you can actually afford to take on more risk within that financial assets. So you can actually invest more in growth assets like equities. And then as you move maybe later, then you can actually adjust your asset allocation accordingly.
I think perhaps maybe just with one caveat, because if you're young and you are, say you have plans to get married, you have plans to buy a house or something, so then you should probably you won't be very motivated to lock up your money. Right? Because if you're talking about 3 years or 4 years or 5 years, then you should be concentrating on saving, because that is actually more important to you as your life goals. And whatever financial decisions and investing decisions we make should be led by our life goals. Yeah. So I think you're in a good space. I think that's great to be young.
That's a good point. I think that's why a lot of times, we say we provide investment solutions, but we recommend people to work with advisors, because they are in the best position to know what your actual needs are, and that's going to be different for each person.
That's right. So you need to balance really living life now and saving for the future, because life doesn't begin at retirement. So at MoneyOwl, we can talk you through that if you think that is useful.
There's a related question over here. So now that we've talked about young people, so Desmond asks, for 60 years old, is it worthwhile to invest as the time horizon is about 15 to 20 years?
Okay, so 60 years old?
Yeah, 60 years old.
Okay, so in the investing during your retirement years is quite different from investing during your accumulation years. And this is actually a financial planning issue. It's not an investment management issue. Yeah. So what happens is that when you let's assume when he says 10 or 15 years, I assume the gentleman is talking about his life expectancy. Now, assuming you're retiring now at 60, you need to have a few things that help you in retirement. And we're talking about 3 must-haves in retirement. First is a house over your head. Roof over your head, and in a fully paid up house. And in Singapore, we are fortunate because most of us own our own homes. right? So if you have that sorted out, the next thing is to have a very good medical insurance to pay for large medical bills. And with MediShield Life, I think most of it's covered at a basic level, and you should consider integrated shield plans, but at an affordable rate. Now, the third thing is then a reliable source of income. So there are a few things here to take note of. The first thing is that for retirement income, you should have what we call a safe retirement income floor. And for Singaporeans, we recommend definitely that you look into your CPF Life, because this is the government annuity that gives you an income for life. So it doesn't matter how long you live, you're beyond that 15 years, you are actually hedging against longevity risk. And so with basically little risk, you can actually look at that. And in our comprehensive planning service, MoneyOwl can help you to look into what this income that you can get from CPF is. Then over and above, you can put in the other assets, which can involve an investment portfolio. Now, I think the question is very insightful, because to talk about the time horizon, you still have a time horizon. Because just because you're retiring, it doesn't mean you move everything to fixed deposits or to very low risk bonds. If not, you would just be inflation will be eating it up, or you'll be depleting it without any being able to participate in markets. There will always be a portion that you only need later. So you need to sort out how to withdraw. And in MoneyOwl, we have a very simple system whereby we believe that if you put your assets at retirement into a balanced portfolio of 60% equities and 40% bonds, which is called a balanced portfolio, you should be able to withdraw 4% of that initial capital that you put in every year. And this should last you for at least 30 years, if not more. That is, it's important to have that rule so that you do not overspend. Now, I mentioned that investing in your accumulation years is different from investing in your decumulation years. When you're investing in your accumulation years, it doesn't matter if you start with negative returns and then positive returns in the markets. It doesn't matter, because at the end of the day, you get the average annualized return. But when you're decumulating, if you start during a downturn, you are actually eating away your base. And so you have to control how much you withdraw. Otherwise, you suffer from a negative sequence of returns risk, and you deplete your assets in retirement earlier than you need to. And when it comes to retirement, investing in retirement, it is not so much the investment returns. You're talking about reliability of the income that you're getting. So again, to discuss these retirement withdrawals, we can. It's the best for an advisor to talk with you through. But generally speaking, this is what we need to do. That and there's thank you for that question, because it really reminds us that investing, it has to be in your contextualized to you. And one of the most major differences is in decumulators versus accumulators.
All right, so now that we're still talking about how we can invest during this period, so Richard asked, how different is this crisis compared to the past crisis? We are seeing a global health crisis, economic crisis, and financial crisis, which is not seen in the past. Yeah, so how is it different?
Yeah, well, I think every crisis has its own different feature. When you think about this one, the virus itself is novel, and around the world, we're dealing with a lot of challenges, and many which are new. If I can offer a little bit positive light, I think there's also another key difference, which is technology and communication. Technology has allowed us as a firm to manage portfolios and to serve clients from home, allow us to do this type of meaningful discussion with clients, and also has allowed exchanges to trade, allowed markets to function as expected, and has also allowed scientists and doctors to fight the virus together. So that's also a difference, because when you think about 10, 20 years ago, we're probably better equipped to deal with a lot of these difficulties today than before. But then I guess when it comes to investment, I would say, although each crisis has its own feature, cause is different, but there are some fundamental principles that are the same. So we continue to believe that markets work. So information is reflected in market prices. So we can continue to rely on market prices to make investment decisions. And we continue to believe that those premiums we pursue should be positive going forward. And there are good reasons for that. I talked about valuation theory being a framework to begin with. And we continue to believe that implementation is the key, meaning that when you think about building a portfolio, you want to make sure that you can reliably capture those higher returns, but you also want to make sure that even when those premiums don't show up, you still end up with a low cost, low turnover, and broadly diversified portfolio that could be a good investment solution.
Perhaps I could speak to then the crisis in compared to 2008 and maybe even the Great Depression, because